Welcome to webinar number 6. We're happy that you could join us, and I've got to warn you ahead of time. Well, most of you know that about 4 out of 5 days I'm working from home during this pandemic, and we have a few cats in our house. Not exactly my choice, but they just seem to be particularly active today. They've been bothering me a great deal. So just want to apologize ahead of time for the potential distraction of a cat running in the background, but I guess that's the world we're living in here. Just a couple of housekeeping items. We have Patrick Gall, another advisor with our group on the call. Patrick, are you there hopefully?
Yep, do you hear me all right?
Can.
Yeah, as per usual, anyone that might have any technology issues with the webinar, if Johann goes silent or you stop hearing him, just fire an email over to info@oceansideadvisors.com and I'll try and connect with you and get your problem solved. Also, there should be a little Q&A button at the bottom of your screen. Anything that comes up during the webinar that you might have a question on, you can toss it in there and I'll be keeping an eye on that. We'll do answer as many of those as we can at the conclusion of this.
Perfect. Thanks, Patrick.
Yep.
All right. And yeah, again, we want to thank you for taking time out of your day. I'm going to try really hard to be, I know I say this every webinar, I'm going to try to be a little bit more brief today, maybe a half hour, 45 minutes. I know I always say that, and then I get in like nerd mode and start elaborating on topics, but I'm going to try to keep it a little bit more concise today. But we really just love sharing, educational material such as this. Sadly in our industry, like there's so much poor advice, just conflicted pieces of advice that come from a lot of programs that might be more driven by advertisement, and just sometimes it's hard to get to the root of advice that pertains to you and is helpful to you. So we hope that our little platform can be a source of advice that you can take with you, and certainly if you do have other loved ones, friends, family, people that think they might benefit from something like this, feel free to send us their email, and we'd be happy just to put them on the invite list for these webinars. We've just been thrilled with the feedback that we've received. So thank you for the encouragement. All right, so spending with confidence in retirement. Just a quick disclaimer here. Through this webinar, Oceanside Advisors does not render or offer to render personalized investment or tax advice. Information provided is for informational purposes only and does not constitute financial, tax, or legal advice. As we always state, we would be happy to give you this advice, but we obviously need to know your personal situation in a little bit more detail in order to give that fiduciary-based advice. Okay. How much income can I safely take from my investment portfolio? All right, this is one of the most critical and complex questions on which a financial planner must advise a client. We receive calls into the office fairly regularly. Many times it's like an introductory phone call, especially recently, where we'll hear from people. There's no way I could retire with all this market volatility, with this coronavirus going on, and all these uncertainties. And so sometimes we don't say it up front on that intro call, but it sounds like you don't have a retirement plan put in place. It sounds like you don't have some decision-making guidelines that can help you through the process. And this is one of the most, probably the most important question that we try to help people address. And it's important to note that what we are going to be going over today, I can take zero credit for. All right, these are, and I'll pull up the names of the papers that we're going to be referencing. But William Bengen and Jonathan Guyton, two pioneers in terms of research in this area. And, maybe at some point later in my career, I'll be able to come up with something meaningful. But at this point, I've spent 16 years now just being a student of markets and financial planning, and trying to implement what we feel are the best solutions with the research and the data that we have. So these two gentlemen will be getting all the credit for the coming slides. Just some really bright people. All right, just to start, it's important to point out that some retirees, actually do not have to worry about initial safe withdrawal rates. Okay, for some people, they're fortunate enough where their spending needs are already covered by things like a defined benefit pension, right? We know there's fewer and fewer of those these days. There are almost no pension plans that are starting for new employees. It's very rare. But some people have all their spending needs covered by pension plans, Social Security, some form of guaranteed annuities. Some people have a home equity, and what I mean by that is they might not feel completely comfortable with the amount of assets they have, but should those assets deplete, they have a tremendous amount of equity in their home where they could potentially sell their primary residence, downsize, and then have another big bucket of money after a sale like that. Some people just have very frugal lifestyles, right? They don't need a lot to be happy. Some people have just such a large sum of money that they could never spend it in a lifetime. And some people kind of have a combination of one or two or three of these. However, the data is really clear that most of today's retirees are left with the responsibility of managing investment accounts to supplement at least a portion of their retirement spending. So this leaves us with the $1 million question, like what is a safe withdrawal rate? And now keep in mind, when I say a safe withdrawal rate, this is the rate that you're pulling from investment accounts, right? For most people, maybe, for most people, you have at least some kind of fixed benefits. So whether it's, Social Security, so maybe half of your spending is covered by Social Security, and you need to figure out the other half from your investment portfolios. So really, this is what we're getting at. What's that safe withdrawal rate from your liquid assets? All right, now, what these two gentlemen did, Bengen and Guyton, really what we're doing is that they're stress testing and planning for worst case scenarios in history. All right, so just to start with the question, and it's more fun when we do these events live, when I present live, and you get to hear some answers. But question: when would have been the worst year to retire between 1926 and today? And from a financial retirement planning perspective, when would have been the worst year to retire? And of course, we get a lot of answers. Oh, of course, like the Great Depression, 1928, to 1932, that would have been horrible. Or, 2008-9 financial crisis, or, .com, or, somewhere in there. And I think the answer might surprise some of you. It's actually 1973. It would have been the worst year to retire. Now, the market decline from 1973 to 1974 was certainly not the biggest. As a matter of fact, in the last 100 years, it barely even fits in the top 10 in terms of equity declines. However, what happened in that period, which both Bengen and Guyton refer to as the perfect retirement planning storm, you have a significant market decline in the same period as you have abnormally high inflation, right? So I'm a little bit too young to have remembered, what this period was like, but I've studied it a great deal, and many of the viewers on this webinar recall. But you had this period of abnormally high inflation with a declining market, and because we're planning for 30-year retirements, a fair amount of these retirees, that maybe if you retired at age 60, they could have lived to see the .com, like the internet bubble burst in the early 2000s. So in terms of a data set and real return, real spending power, 1973 would have been the worst year you could have possibly retired financially. And so I guess that's just the first point I wanted to make. Like a lot of times when we look at retirement planning, people think it's just about like the market decline, where really inflation plays a massive role in outcomes. Okay, so first gentleman, William Bengen. Okay, so he had 3 landmark papers in the 1990s. Okay, so he is the author, the creator of the so-called 4% rule. All right, so some of you probably have heard that term before, 4% rule, and we're just going to dig in a little bit of how he got to this rule, 4%. All right, so his methodology and assumptions, what Bengen was looking for, he wanted to find the initial safe withdrawal rate that must be able to withstand 30 years of portfolio longevity for all retirement dates. All right, and also assuming the client is going to increase withdrawals based on inflation each year. All right, so it doesn't matter if you retired in 1926 or 1940 or 1973, right? Whatever this withdrawal rule is, the retiree needs to be able to make it through 30 years without their money running out. Okay, and his recommended range of equity allocation in stocks was 50% to 75%, and it's a little bit more detailed than that. I'm just trying to hit the bullet points, but of course, earlier in retirement, a higher equity allocation, and then as you get older, that allocation drifts down closer to 50. Historical data was used from 1926 until he put this paper out in 1995. What he used after 1995 was just the average returns of everything from that period, right? Because of course he wanted to finish the data set. So he did use some assumptions based on previous historical data. And the equity portfolio was composed of US large cap stocks. And I put US large cap stocks in a different color because that's going to become important for the coming slides here. All right, so based upon this big formula and all these different rolling time periods, what Bengen concluded that the initial safe withdrawal rate for portfolios in retirement with a 30-year time horizon is 4.1%. Right, so this is where that the so-called 4% rule came from William Bengen and this paper. All right, now just quickly touching on the initial research had the US equity portion in 100% US large cap stocks. So in other words, your big blue chips that everyone's heard of. And while, I think we would all agree that portfolio, you should own a nice chunk, a healthy allocation in blue chip stocks. We do know that in the long run, although more volatile at times, small cap equities have a higher expected return. So Bengen did some research a little bit later on and found that if he were to just put 30% of the equities in US small cap, all right, so in other words, of the equity allocation, if instead of 100% US large caps, if he used 70% large caps and 30% small caps, this initial safe withdrawal rate actually increases to 4.3%. Right, 4.3. And so then we're going to jump into Jonathan Guyton, because Guyton basically took all of Bengen's research, which he was, like anyone, but it was a very impressive report that Bengen, he put out 3 reports. But so what Guyton did in the early 2000s is he just built upon Bengen's work. All right, and what Guyton was wondering, he said, hey, what if we could increase or improve Bengen's safe initial withdrawal rate by using 2 things? All right, so the first is, and you already got a little glimpse of it, where Bengen was just using a U.S. large cap and a little small cap. Like what if we actually implemented modern portfolio theory, so broader diversification, and had some portfolio decision rules that would help us along the way? And the second thing that Guyton added to Bengen's rules were, what if we actually put in place some withdrawal decision rules, some financial guardrails, some guidelines that we need to abide by throughout retirement? Like, could you come up with some defined metrics that could help increase that initial safe withdrawal rate? And so we're going to look at both of these. So the first one we're going to is this modern portfolio theory. Okay, so modern portfolio theory and decision rules. So what Guyton did is, instead of just using the 2 asset classes that Bengen used at the end, his most recent research, what if we use more than that? What if we use multiple asset classes for the equity portion of portfolios? Because we know this provides a significant advantage when identifying assets to use for funding retirement withdrawals. All right. Additional diversification also produces a higher long-term expected return, importantly, without increasing the volatility. All right. Now, Guyton didn't come up with modern portfolio theory. That came long before him. But he was the first to take it and see how it interacts with withdrawal rate strategy. And I know if you have watched previous webinars or been to our office, or we help you, you know that I harp a lot on the benefits of diversification. And it's easy to get stuck in the trap of, the last year or two, US large cap growth has done so well, right? Your Apple, Amazon, Netflix, Microsoft, Facebook, Google, they've all done so well. Like, why don't we just overweight that forever? And the answer is because in the long run, that's not going to play out. But more importantly, and especially when it comes to retirement, having a more efficient, diversified portfolio of different asset classes within equities, as you're going to see, it's going to provide significant advantages in terms of identifying which assets to use for withdrawals. Okay, and so what Guyton did, so in a 65% equity portfolio, all right, this is what it looks like. All right, so he has 10% cash, 25% fixed income, 13% US large cap value, 13% US large cap growth, 9% US small cap value, 9% US small cap growth, 15% international equities, and 6% in REITs. All right, so real estate investment trust. So again, the benefits of diversification, we know, different asset classes go up and down at different times. So it provides you with an additional amount of flexibility that is really nice to have for retirement planning. All right, so what Guyton said is this is just a small, so modern portfolio theory, that this is just the first part of it, because you also need to have portfolio decision rules in order to implement this in the best way possible. So the way that works, and I was thinking about making a whole slide, but again, I wanted to try to keep it a little bit more concise today. I'm probably failing already at that, but so in terms of the rules, the portfolio management rules that you need to follow. All right, so at the end of each year, the way you fund cash for the upcoming year, for the upcoming withdrawals, he says you need to do it in this order. First of all, you need to trim equities that have become overweight. All right, so let's say, the initial target for US large cap growth, 13%. Well, maybe that fund has done really well, and all of a sudden that's 15% of the portfolio, right? That's 2% right off the top. You're going for that. You're going to trim that down. That's going to fund the following year's withdrawal. Okay, number 2, you trim fixed income positions that are overweight. Number 3, you withdraw cash. Number 4, if it hasn't been funded yet, number 4, you would go to whatever's left in fixed income. Lastly, number 5, you would go to whatever equities are left in the portfolio. So you go in that order, 1, 2, 3, 4, 5, and you have to stick to those rules with the 65% equity portfolio. Now, if you follow those rules, again, and I would invite you to read the paper. It's really impressive. But if a retiree follows specific these portfolio management rules, the initial safe withdrawal rate is now increased. You have the ability to increase that withdrawal to 4.7%. 4.7%. And now, you might ask me, like, Johann, is it really that big of a difference getting a portfolio withdrawal amount up from 4.1 to 4.3 to 4.7? And my answer would be yes. Like that can be a huge difference over time. For example, let's just take somebody that has $1 million, right? 4.1%. If you're stuck there, that's $41,000 of withdrawals for a year. Right? If we can get that to 4.7, that's $47,000 in a year. So $6,000 difference. That's $500 extra you have every month in discretionary income. That can be a huge difference to someone in blessing someone else's life. Maybe you're giving money to a kid or a charity, or $6,000. Maybe you're going on 1 or 2 more vacations a year. Like that's a huge difference in withdrawal percentages. And so we're going to keep going, because this is just part 1 of Guyton, and the second part is my favorite. So part 1, again, this is his modern portfolio theory and portfolio decision rules. The second part he came up with comes on the withdrawal side. So decision rules on the withdrawal side. And you see this nice little picture here. Guyton has a wonderful analogy that he put together for this research. He says, you can think of retirement like a financial road trip. So your retirement's a financial road trip. And you picture yourself, driving in a car, right? Like on this road. Just picture yourself driving in a car. And you look down at the speedometer. All right, now you can think of your withdrawal rate out of your accounts like the speed of the car. Right, so you're driving, you're looking down, and it says 4.7%. Right, that's your speed. Your withdrawal rate is the speed of your car. Now, what if someone told you that your car had no brakes, no mirrors, and there are no guardrails? Like, what would you do? And the obvious answer is you'd slow down, right? You would slow down. And what Guyton says, like, as much as he built his research off of Bengen's original papers, but what he finds is like that's the shortcoming of Bengen's research, right? The 4.1% rule, that's assuming you have no brakes, no mirrors. You're going through retirement with your head down. You're completely blinded from what's going on in markets, what's going on with inflation. Bengen's 4% rule says you can draw 4.1 or 4.3 if you have some small caps, but basically the 4% rule, you just put your head down and you draw income plus inflation each year, and you never have any consideration for what's going on in markets, inflation, anything else, period. And so Guyton says, well, wouldn't it be nice if the market was having a crummy year or two and you could tap the brakes? Wouldn't that mean that you could go faster to start? And that's what kind of encouraged him to drive in, to continue looking into some of these withdrawal decision rules. And even between his first paper and his second paper, it really evolved as they continued to look into more and more ways to improve it, the process, as it relates to initial safe withdrawal rates. All right, so to look at these withdrawal rules, we're going to go through Guyton's decision rules, okay? Okay, so retirees have the ability to increase their initial safe withdrawal rate if they are willing to use financial guardrails and make adjustments to their spending if necessary. All right, so the system that Guyton put together, there's 4 rules, right? So number 1, if the prior year's market return is negative, right, you need to apply the portfolio decision rules that we went through in step 1, right? That had to do with the efficient market, modern portfolio theory, portfolio decision rules. Number 2, and I'll take a little time to explain this one, but if current withdrawal rate is within 20% of the initial withdrawal rate, you get an increase in your withdrawal by whatever CPI is for that year. All right, so I have to just make a simple example of this. So let's say your initial withdrawal rate's 5%, right? So 20% of 5 is 1%, right? So you can kind of think of, all right, so if we start with an initial withdrawal rate of 5%, we're going to set financial guardrails 1% on each side, right? So 4% and 6% on the high side, right? So as long as your current withdrawal rate for the year is somewhere between 4 and 6%, right? So within 20% of what you started with, you get an increase in the amount you get to withdraw on whatever inflation was for that year, CPI, all right? Now, step 3, if the current withdrawal is less than the initial withdrawal rate by 20%, you get to apply what he referred to as a prosperity rule, and you get to increase your withdrawal by 10%. All right, so again, just going off the same example. So if your initial withdrawal rate is 5%, so your guardrails are 4 and 6. So say the market does really, really well, your spending remains constant, but the balance of your portfolio increases, right? So now all of a sudden you find yourself in your withdrawal rate for the previous year is only 3.9%, right? So now you're less than the initial withdrawal rate by 20%. Well, then you get a 10% bump in your withdrawal rate for the upcoming year, plus inflation, okay? Now we know there's no free lunch, and this is where we get back to the analogy of sometimes you got to tap the brakes. right? If a current withdrawal rate is greater than the initial withdrawal rate by 20%. So in other words, this 4 and 6% we've been discussing, if the market gets crushed, your portfolio balance is lower, and now all of a sudden you look down and you're outside of the guardrail. Maybe your withdrawal rate is 6.2%. Then you need to apply what he referred to as the capital preservation rule and decrease your withdrawal by 10%. So you need a pay cut. You've got to take a pay cut by 10%. Just for that year, And what they found in these guardrails is the average retiree should only need to take 2 or 3 pay cuts over a 30-year period, whereas the prosperity rule, the increases typically happen 7 to 8 times over a 30-year period, right? So here you're driving your car, you have brakes, you have mirrors, you're aware of the market going, what's happening around you. And if you follow these rules, a 5.3% initial withdrawal rate is sustainable at the 99% confidence standard for portfolios containing 65% multi-class equity. And notice the last part of this sentence, over 40-year periods. So, but by the time he was doing this research, of course, people are starting to live longer. Instead of Bangen's 30-year research, he said, I want to make sure this works over 40-year periods. Right, so 5.3% initial withdrawal rates, sustainable at the 99% confidence standard for portfolios containing 65% equity. If you're okay with 95% confidence, this withdrawal rate actually increases to 6%. All right, I know most of the people we help prefer 99% more than 95, but just I thought some people might, I don't know, but yeah. So if you want 95% confidence, that withdrawal rate can increase to 6% if you're doing it right. So ultimately, like, what is most appropriate for you? Really, it depends if you're willing to make adjustments. Like some people. And there's no right or wrong answer. Like some people would just say, hey, I'm not comfortable with ever taking a pay cut in my retirement. And that's totally okay. And if that's the case, like you probably just need to make sure your withdrawal rate's closer to 4%. The other important piece is you need to be comfortable holding some equity. And I know that especially in periods of volatility and uncertainty, like it's hard for people to hold stocks, equity funds. And the problem longer term, if you're not holding enough, for example, if instead of 65% equity, if you're only holding like 50% or less, like this withdrawal rate goes way down from 5.3. It's not, now you're way down to the 4, even in the 3s. Of course, if you're down to like a 25% equity allocation, your withdrawal rate's probably in the 2%, right? So, there's no right answer for everyone. It's really based upon your unique situation and what you're comfortable with holding in a portfolio. So let's see how I did. Oh, that wasn't bad. Yes, all right, just a little over a half hour. This is, hope you found this helpful in terms of withdrawal decision rules and initial safe withdrawal rates. Just wonderful research. And again, I would encourage you to, I'd encourage you to look at the papers yourself, because it's really fun just to see how the papers have evolved. The research has evolved over time in trying to help people have a higher initial withdrawal rate. And why is that important? I guess I should add, like, the data is really clear in that most retirees want to spend the most right at the beginning of retirement, right? Because that's when you have your health, that's when you can travel. And what the data shows is that they call it the retirement smile, right? So as you go through time, like you usually have higher spending up front if you can, which is why something like this ladder strategy might be better for you. But then kind of towards the middle of retirement, real spending, so inflation adjusted spending goes down. And then, sometimes for some people, if you have health issues and you have nursing home, spending can go back up towards the end of retirement. So it's kind of like this retirement smile. That's a whole separate research paper. But in other words, for a lot of people, it makes sense trying to find the highest withdrawal rate that's still safe in retirement, which is why I thought this was worth having as a topic for a webinar. So I hope you found it interesting and helpful. And yep, Patrick, if we have some questions, I think we'll try to take some.
Yeah, we have a bunch of good ones here. Try to get to 2 or 3 of them. With these initial withdrawal rates, this question's from Matt. With these initial withdrawal rates, are these pre-tax or after-tax withdrawal amounts?
Oh, good question. Yeah, and I probably should address that. So everything we went over, all this research, it would all be a pre-tax withdrawal amount. All right. So, and that's important because, for example, if someone has hypothetically a very large IRA, right? So let's say there's a $3 million IRA, right? So, and they're starting at a 5% withdrawal rate. So 5%, 3 million, that'd be $150,000 withdrawal rate to start. That person's after-tax amount, might only be 100,000, right? Somewhere closer to that. Whereas someone with in a lower marginal income bracket, marginal tax bracket, might be able to keep a much larger amount. So great question. Everything we've touched on is these are all pre-tax withdrawal amounts.
Another good one here from Stuart, and I feel like a very him question. If you follow the final model, what are your assets at the end of 40 years?
Yeah, Stuart, I don't know. So I think the question would be what the average assets would be at the end of 40 years. I don't know the answer to that. Like I'm sure if I contacted Jonathan Guyton and looked actually at the hard data, we might be able to see what the remaining assets would be. But keep in mind from the slide early on, these withdrawal rates, they're all about finding what withdrawal rate can you take and not run out of money, right? So what withdrawal rates can we take with leaving yourself with very little, right? Like a 1% risk and a 99 confidence standard interval of not running out of money. So I don't know the answer to that question, Stuart. That's a very fair question. I wish I had a better answer, but it's this research is more based on not running out of money and not so much ending assets.
I mean, it's also one that you can't really give an answer with utter certainty given the flexibility of inflation, up and down markets at the end. I feel like it's gonna vary tremendously person to person and retirement time frame to retirement time frame. I do like the question though.
Besides his follow-up question, so the expectation is your assets are totally depleted. No. The expectation is that you would have the expectation is that you would have tremendous assets left over. Okay, so it's $0 left isn't the what would be like your average return. Like $0 or $1 left in the portfolio would mean like this is a worst case scenario if you follow these rules. Like that's the absolute worst case is you're getting down close to zero. So the average, the expectation would be you would have a tremendous amount of money left in the account. And if things went well, then then you'd have even more money in the account. But so really what we're focusing on is like that tail risk, that very bottom end, like worst case scenario. What can we still feel safe about withdrawing money? Oh, and he said thanks. So I guess my follow-up must have been more satisfied with my follow-up. Yeah. Yeah. Stuart always has good questions. He's always fun to hang out with too.
Yeah. Question from Ted. If you have an IRA and a non-qualified account, where should you be withdrawing from first?
That was from Ted?
Yeah.
So if you have an IRA and a non-retirement, where should you withdraw from first? Okay, the answer to that question, the good answer to that question would probably take another webinar to go through the way you would calculate which account you should be withdrawing from. But I'll tell you the short answer. What usually happens, Ted, is you usually want to be using your non-retirement assets first for two reasons. The first reason is by using the non-retirement assets, you're keeping your tax rate down, which would allow you to be making like Roth conversions early in retirement, right? Because you'd be staying in a lower tax bracket, like Roth conversions with some of the IRA. The second reason you would use non-qualified assets is you would allow your IRAs, your other retirement accounts, to continue growing tax deferred for more years into the future, whether that's IRAs, Roth IRAs, letting those grow longer. So that would be the short answer. Although again, it's the best thing to do is probably a combination of both, and that the true answer, you'd really have to take a detailed look at someone's retirement picture. Anything else, Patrick?
Here's a good one from David. Is there any assumption of how much your assets would continue to grow? For example, if you withdraw a certain percent, he used 4 here, growth of 9%.
Yeah, so what they're doing, David, in the research, what Guyton was doing in the research, they were using real returns, like real inflation, real market declines, over the last, call it 100 years. And if it was as simple as, withdrawal or, growth rate minus withdrawal, it would be an easier problem. The issue that comes up and that we see a lot of people overlook planning their retirements is inflation, right? So there's inflation that complicates that equation. And then what complicates it even further is the sequence of return, right? So in what order does that growth come? In what order does inflation come? In what order, are there some really bad market years stacked together, like in 1973, 74, while inflation's going? So it's, so the assumptions they used were, strictly what's happened the last 100 years. They were using real data. So I hope that kind of answers your question. All right, and I see there's a handful of other questions coming in, but what we will do, because this is great, 45 minutes, I finally did it, Patrick. What we'll do, these other questions on here, we'll gladly send some email responses to follow up. But again, we thank you for joining us, and we hope you found it helpful. And again, please feel free to let us know if there's another webinar topic you would like to hear discussed. We'd love to do that for you, or friends or family that might want to see the next webinar as well. So we appreciate you taking the time, and yeah, enjoy the rest of the week.